Hi, I'm Alex Miller, and this is the Citi Institute podcast, where we explore the forces shaping finance, the global economy, and the way we live and work. In each episode, we bring you insights from thought leaders and innovators driving change, helping you stay informed, navigate challenges, and seize opportunities in a rapidly evolving world.
We've been talking about these themes for a long time, but those famous last words in finance, this time is different. But in the case of blockchain and digital assets in the institutional space, in the US, in Europe, it is different.
You cannot have the innovation without having a safety-first approach. It's not a trade-off. It goes hand in hand.
I'm absolutely delighted to be joined today by Caroline Pham, Acting Chairman of the CFTC, alongside Ronit Ghose, who runs the Citi Institute's Future of Finance research efforts. Today, we're going to discuss the intersection of stablecoins, cryptocurrency, blockchain, and how policy is supercharging innovation in digital money and digital assets, both in the US and around the world. Caroline, let me start with you. Welcome, and thanks for joining us at the Future of Finance Forum here at the Citi Institute. Why do we need crypto? What problem does it solve, or is it an answer still in search of a problem?
Thank you so much for having me here on the podcast. It's really a pleasure to be here and to be doing this with a former colleague as well. And I really enjoyed working in the past on the Citi GPS reports, which are now part of the Citi Institute. So when we think about crypto and digital assets, I think it's important to distinguish between three distinct value propositions and use cases. So number one is the digital asset as essentially just a new form factor. It's no different than from when we went from paper trading to electronic screen trading to now perhaps trading on a digital blockchain. And so once you think about it as just simply a different form factor, then it makes so much sense why the legal and regulatory framework for tokenization of financial instruments really should adhere to the principle of same activity, same risk, same regulation. So that is something that's, I think, very important to distinguish is tokenization of financial instruments. The second one, which is, of course, got a lot of attention and is of great interest to many, not only in the United States, but also all over the world, is crypto as a new asset class. And so crypto as a new asset class is particularly compelling. There's, of course, Bitcoin and Ether, but there's also the interest in protocol tokens or network tokens. I almost think of these as consumables, almost like oil or gas or energy, because they actually power the protocols that they are natively issued on. And so if you think about it that way, as a consumable, then it makes sense why it's a new asset class, just like any other commodity, like oil or gas or energy, lumber, etc. When you think about crypto as a new asset class, I think the key question from a legal and regulatory perspective is one of equivalence. We shouldn't be treating crypto as an asset class any differently than we treat other asset classes, of course, ensuring that it's from a risk-based perspective. So if there are certain characteristics of the asset, if it's a volatile asset, then you're going to want to have the appropriate risk controls for that. But just because it is crypto, separate and distinct from any data or market conditions, does not mean that it should be unduly penalized. So that's where a lot of the work remains to be done in the US and also around the world. Finally, we can think of just blockchain technology. And the tokens on that blockchain technology can be representative of anything. It's essentially a very good record-keeping system. So of course that has benefits for logistics, supply chains, anything where you need to track something and lots of it. So there, that impacts not only the financial sector, but obviously all sectors of the economy and the public sector as well.
That's fascinating. Maybe, Ronit, I could turn it to you. In your recent report titled Digital Dollars, you talked about the broader digital money landscape. Can you just walk us how the technology of money is evolving, and particularly what a digital dollar might mean in real terms that would be understandable to all of us?
Absolutely, Alex, and it's great to be here on the podcast with Caroline. Digital dollars, so the idea of digital money is a little bit of a misnomer. So let's clarify that. We have digital finance here in the UK, back in the UAE where I'm now based, in the US, around the world. Digital finance exists and has existed for years in both the consumer and the institutional space. What we mean by digital money or digital money 2.0 is digital asset or blockchain-based money. The concepts I would think about is account-based versus token-based. Now, if you're not in finance, let me unpack that. Account-based is think of it as a bookkeeping entry. You make a note in a notebook that says, Alex has £1 or Ronit has 1 dirham. That's an entry in a book. And this is literally how banking books evolved. Back in the 1200s, 1300s in Italy, sort of the genesis of at least European modern finance, you'd have bankers sitting on benches, hence the word bank, sitting on benches in piazzas in Italy, and they'd have little books and they'd have diary entries. And if they didn't manage their money well and they went bankrupt, you'd go and break their bench. So that's where bankruptcy comes from. But it's a book. And then when computers arrive in finance in the late 50s, you move those books or ledgers onto computers. So we got banking books or ledgers becoming digital ledgers. So that's account-based. And when we have digital finance today, so your banking app, now tokens are different to book entries or ledger entries. Tokens I think of as a coin, a gold coin or a silver coin or a bronze coin, which then becomes a banknote. And now a token, a stable coin, or a Bitcoin is a blockchain version of that banknote. So a regulated stable coin could be seen as akin to a blockchain version of a banknote issued before the Federal Reserve, when we had lots and lots of commercial banks. A CBDC, a central bank digital currency, would be the equivalent of a banknote issued by the Federal Reserve or the Bank of England on a blockchain. Now, those are exact, and if there are lawyers listening to this, don't DM me to point out the mistakes in the analogy.
Yeah, and I mean, obviously there's always been evolution in the world of financial markets and money, but it feels like now particularly so that the pace has increased.
Absolutely, and Caroline touched upon some of this. We can keep score or exchange value. It could be a grain of rice, it could be a piece of paper. As you get bigger societies where you don't know people, you need some form of external authority. And they basically say, this is what money is. So an external authority says what money is. And so what's been missing in the whole blockchain revolution the last 17, 18 years is this external, legally validated money on-chain. You've had private sector like assets on-chain. And with the legislation that's happening now in the US and with MiCA in Europe last year, and in the UAE, there's legislation in Hong Kong. These legislative frameworks are giving large institutions, such as big banks like ourselves, confidence to engage with these instruments. And that's why I think we're getting this leap forward.
Well, maybe that's a good point to bring it back to you, Caroline. In terms of your joining, or I think maybe even rejoining CFTC in 2022, what changes have happened in that digital asset ecosystem, and particularly also in the policy world, that stand out to you?
From a Washington perspective, if you think about policy, something that was unique about the debate around crypto in the United States is that somewhere along the way, it became this narrative of a battle between good and evil, and crypto was evil. This narrative played out in public opinion, it played out in politics, and I think it's really quite unfortunate because no technology is inherently good or evil. It's the people who use the technology, right? So what's been very refreshing ever since the new administration and January is that we are stripping away this very emotional narrative that has been projected onto a technology, onto crypto, and we're really looking at it almost with fresh eyes from a very pragmatic and practical perspective. What's been really enjoyable for me since I've become acting chairman in January, and truly throughout most of the government agencies, is you've seen a return back to basics of good government. You've seen a return to data-driven policy, and you've seen a newfound pragmatism and a focus on delivering results. And so having a renewed sense of purpose with a clear goal in mind has been incredibly beneficial for the US policy environment, particularly for regulatory clarity for the United States. The tremendous momentum and optimism that you feel, this energy that you feel in Washington, is because for the first time ever, it feels like you've got a whole unified approach across government, all unified under the strong leadership by the president and with his executive orders in particular, including the creation of the President's Working Group on Digital Asset Markets, of which I participate in. And we are publishing a report that is due to come out next month, which will create the roadmap for the administration.
Maybe, Ronit, I could ask you to sort of pick apart some of the debates in terms of private cryptocurrencies relative to another acronym, CBDCs, central bank digital currencies. I know the Institute and yourself, you've looked at this significantly. How do you see those coexist, or indeed sort of can they coexist going forward? Not so much next 2 or 3 years, but let's go next 5 to 10 years.
CBDCs, or central bank digital currencies, are sovereign money on chain, either on a blockchain or on a technological system akin to a blockchain. Sovereign money that, like a banknote, that we can use in a digital asset ecosystem. Stablecoins, like we were discussing before, are more akin to commercial bank money, on-chain, because they're linked to sovereign money. So the idea is, if you're a regulated stablecoin issuer, if you have a dollar stablecoin from ABC regulated stablecoin issuer, you know, due to audits, regulation, there's $1 of reserves, typically held in T-bills, so short-term, short-dated, very liquid, US sovereign paper, and or other similar assets. Now, cryptocurrencies, private cryptocurrencies are different. So the best known, the biggest in the world is Bitcoin. Bitcoin is an asset that has cash-like or money-like properties, but I tend to think of it more as akin to some Bitcoin supporters think of it as digital gold. It's a blockchain version of gold. Why do we hold gold? Because we see it as inflation-proof. We see it as a reserve, a store of wealth.
Safe from disruption.
Exactly. So there's huge amounts of gold held around the world by central banks, but particularly by private families, in particularly India and China. So there's this one narrative, which is Bitcoin is meant to be digital gold. Originally, so if you go back to the original sort of white paper, the Satoshi Nakamoto white paper, the idea was it was going to be e-cash. So it's going to be like cash, peer-to-peer transactions. So the original Bitcoin believers, and we've come a long way since 2008, the white paper, in 2009, the first transaction, it was actually a rebellion against institutions and centralization. It comes out of what was called the cypherpunk movement. It was somewhat anarcho-libertarian. It's the government or the Federal Reserve or big banks, they don't need to know about.
Very particular origin.
There's definitely an evolution. Bitcoin has a proven track record. Stablecoins have become a big thing as part of the crypto ecosystem in the last 5 years, but they're relatively so far outside the regulated financial industry, and that's what's changing this year with legislation. And then we're going to get, and we've seen pilots already of deposit tokens and other similar type of instruments. Those are also going to grow. So it won't just be stablecoins in the US or CBDCs in Europe and Asia. You're going to see deposit tokens or tokenized deposits as well being issued by banks.
And I want to pick up on two things that Ronit said, which I think are so interesting. So one of the things is that you talked about Bitcoin as a store of value, and those who believe that Bitcoin is like digital gold.
Yeah.
Why is something valuable? It's valuable because we believe that it's valuable. And if you think about the success of Bitcoin, it might be the ultimate network effect, that you have been able to have millions of people around the world who believe in the value of Bitcoin, that Bitcoin is something of value, that Bitcoin is valuable, that Bitcoin is something that I want to hold on to because I believe it will be more valuable in the future. That's something else where you have millions of people around the world that are united or unified under a common set of beliefs. So this is just something I think that's quite remarkable about Bitcoin, almost as a movement as well.
Yeah. And it's a value. It's not just because you and I say there's a value, right? So the value in Bitcoin, like the value in other sort of, say, belief systems, is that there's actually an instrumental purpose, which is in this case of Bitcoin is it's been road tested for 17 years, that I can have a form of decentralization. Okay, I need electricity and the computers and so on. So if everything fails and in a post-nuclear apocalyptic scenario, Bitcoin might struggle. But I can have stores of value or transfers of value outside centralization. So I'm basically saying there's a value to decentralization. So if I said, listen, I don't believe in decentralization. If I said, I just think, my digital account at ABC Big Bank or XYZ Community Bank is fine, I'm not going to ascribe value to a Bitcoin, am I?
Right. Well, so there are the origin stories, of course, around the early days of Bitcoin.
Yeah.
And so many of those focused on banking crises in certain countries.
Yep.
And so, of course, that's where the value proposition of decentralization comes from, because if you are in countries around the world and you have got concerns about political stability or the rule of law or regulatory clarity, then it's appealing to have something that is decentralized. And so therefore you can almost view it as a hedge against a certain type of risk. The other thing I think that really propels those who believe in the value of Bitcoin, of course, is that it is programmed scarcity. And so the idea that this is programmed scarcity, and when something is scarce, that it is valuable, I think that's very unique and common to human nature and goes back, I'm sure, to the earliest days of humankind.
Well, maybe I could ask you just to pick up some of the points Ronit was saying there, Caroline, in terms of stablecoins and thinking about how significant that market might become, and also use cases that will resonate with an audience who aren't always deep specialists like yourselves.
So this is where it's exciting to switch from talking about crypto as a novel asset class to stablecoins, which are essentially either tokenized private money or tokenized assets. And so to me, and I come from a markets background and I'm a markets regulator, the killer app for stablecoins is collateral management. Let me give you an example. I regulate the 700 trillion notional global derivatives markets, and you need to post margin and collateral every single day in vast quantities in order for our capital markets and other financial markets around the world to work. No matter what asset class it is, whether it's FX, rates, commodities, equities, credit, all of these asset classes, you need to be able to settle it with a cash leg or with some type of asset, as Ronit said. And so when you combine the efficiencies and the benefits of this new technology, blockchain technology, with the need to be able to settle and to be able to settle at the same time, right? Because the banking system doesn't move at the same speed as, for example, what we can do in our modern day equities markets with high frequency and algorithmic trading. So this, I think, is really where when you can have those capital efficiencies, you are freeing up so much more of the balance sheet that financial institutions in particular, but also any other type of company, can then deploy, can then maximize. So for example, this is why when I look at the public interest around creating regulatory clarity for digital assets in the United States, I think of it as one way to help to propel greater flow of credit to U.S. businesses and U.S. households because of the fact that when banks are able to have the capital efficiencies, again, from this improved form of collateral management, they can then redeploy it to provide credit to businesses and households. So this is something, I think, which is a tremendous innovation. It is not something that people really think about. Nobody walks around going, oh, collateral management is the most exciting thing that I've ever done. But it's vitally important to our global financial system.
I mean, this feels like something that gets lost in the debate sometimes, that actually the purpose here is potentially to unlock new innovation through the balance sheets of major companies being made more efficient. Is that something that, do you think, needs to be better appreciated? And what do we need to do to get to that point? Obviously, this podcast is part of that.
Humans are a society that is built upon stories. And I think that this story is one that needs to be told more, but it also needs to be told in a way that is more accessible to more people, because the people who get super excited about collateral management are like traders on desks, market and credit risk analysts, treasury function, middle and back office.
People deep in that space.
So I think that's where it is important that we find a way to bring this story about the efficiencies. But I think if you just say, look, this is better technology, look at how the internet has transformed the way we do commerce, for example, e-commerce, right? And the efficiencies that it brings and the advancements that we've been able to make in that way. And so why not look at this as new and better technology that can enable our global financial system to work better, to get credit to where it needs to go, to get money to where it needs to go.
I love your point about stories and being able to kind of bring this to life in a way.
We're telling a story right now.
Yeah, no, it's so powerful. Ronit, you've spoken separately about the programmability of money. What do you mean about that? And practically, what does that mean in terms of what governments, businesses, consumers, how are they going to interact with money? Is it different from today?
Maybe I should tell a story.
Yes, do.
So remember, Alex, when we were kids, you'd be given often book tokens rather than general purpose gift vouchers. So
a card with a £5 token.
Yeah, and it would say you could only buy a book with it. So there's like programmability in a very basic sense in that gift voucher. It's not money. I can only use it for a particular type of thing.
Designated purpose.
Exactly. So programmability allows, through software, through code, those kind of purposes or targeting to be done. So either in terms of use cases, you can only use it to, say, buy books, or for a particular type of aid that the government's giving, or in terms of conditionality, that the money gets paid out if ABC happens. So in trade finance, the ship docks at this port, the goods are checked and verified, and it moves to another port. Or in an insurance contract, the temperature goes above 45 degrees, so the rainfall is above X number of millimeters. The contract pays out immediately. It's programmed, so it's programmability. Programmable money allows just customer satisfaction, the financial services industry, to basically take the pain away from day-to-day life. None of us really want to spend our time thinking about how does my insurance work, or when is my mortgage getting paid, or whatever.
So this is automation factor and convenience.
Exactly, and programmable money is just saying it's automated. If X happens, Y happens.
And is that different from smart contracts, or are they sort of underlying technologically similar, but actually?
I think the smart contract is the programmability aspect of it. And actually, because I am a regulator, I will bring it to risk and compliance. When we think about the way the financial system works, it is a system-based approach. So we have trading systems, we have banking systems, we have payment systems. And the safeguards for banking, for trading, for payments, those safeguards are built into the system. There are controls that are in that system. What is very interesting about blockchain technology, and this goes back towards what Ronit was talking about, the difference between account-based and then being token-based, is that applies to this idea that instead of having a systems-based set of controls. You can embed the controls through smart contracts into the token. So if we now have token-based risk controls, token-based compliance controls, token-based due diligence, token-based KYC, all of those things is what actually enables DeFi and public blockchains. And there you're talking again about a network effect. One of the value propositions for DeFi in markets is that it is the ultimate liquidity aggregator. On a public blockchain, you can bring all counterparties to one place, and that gives you a depth of liquidity. So that is only enabled if you have token-based compliance.
That's fascinating. And actually, maybe just on that safety aspect, I mean, one of the great things, the US is supercharged policy. There's this palpable sense of excitement across government, but also across the private sector at the moment. How do you think about that sort of charge towards innovation and growth, which the US is always famous for? I think a recognized leader globally for that, relative to that balance of safety and doing the right thing. How do you strike that as a regulator?
I think anytime you do innovations, you want to ensure that the safety is there. Let's think about self-driving cars. Self-driving cars, particularly for the trucking industry, could be something that can improve safety if you can lessen the risk of somebody falling asleep on one of these long-haul drives. At the same time, there's obviously a tremendous risk, death, from self-driving cars. And so you cannot have the innovation without having a safety-first approach. It's not a trade-off. It goes hand in hand. Now, the other thing that is, I think, a story that doesn't get told enough is that traditional financial institutions and traditional asset managers and other market participants, financial market infrastructures, service providers, they've all been working on blockchain technology and tokenization since at least my time, which is I started working on it at Citi in 2017. And they've been doing so hand in hand with their regulators, hand in hand with the bank supervisors, because as a bank, you can't do anything without the supervisory aspect. So what people don't realize is, number one, tokenization is real. I recently gave remarks where I noted that the size of institutional repo and payments on blockchain is over 1.5 trillion. It might be a conservative number actually, and that's real. That's a real number, 1.5 trillion. And because it's institutional, all of that 1.5 trillion was done under bank supervision or other type of regulatory supervision. And so this idea that it's been a free-for-all is just not true. Because how could you get to that 1.5 trillion if you didn't have the regulations that went hand in hand with it all along?
So two sides of the same coin.
That's right.
So Caroline there was talking around about the transformational aspect of digital money, and you talked in your Digital Dollars report around how kind of global financial infrastructure is going to need to evolve further. What do you think kind of our institutions, whether they could be public sector, governmental institutions or private companies, need to do to begin to prepare for this or continue to prepare for this? What are the priorities?
It's a cliche to say regulatory clarity, but regulatory clarity has been emerging in different jurisdictions over time, and this has become accelerated this year in the US. At the same time, institutional comfort and greater institutional credibility and resilience of the partner firms in the digital asset space has grown. I was recently told, so this is not my, I'm just recycling something someone's told me recently. They said, listen, remember back to the cloud, the public cloud, when the big tech firms first came and said...
Early 2010s, I think.
Yeah, mid-2010s. Actually, even before then, people came and said, why host everything on-prem? Why do everything yourself? We're running these massive computer infrastructures. We'll host your compute for you. we weren't sure as an industry, and the regulators weren't sure how stable and reliable these companies would be.
There were questions, weren't there?
Totally. They were relatively small companies, but their processes and their resilience and their institutional practices just got transformed. And the regulators, the banks, we all got more comfortable. Now, we still don't put everything, or compared to more digitally native companies or fintechs, we as banks don't put everything onto the cloud. It's still a journey, and it'll be the same with blockchain. It'll be a similar journey. But it's definitely happening, and this is not new. There are many people here. We're recording this at our Future of Finance Forum, of course, and there are many people on panels, but at round tables this morning who were speaking from startups, from scale-ups, who started that discussion by saying, I worked at Citi 5 years ago, or I worked at Citi 7 years ago on digital assets, and now they've gone off to set up their own companies and they're building in the space. So often these partners we're working with, either vendors or investee portfolio companies, are staffed by ex-bankers.
And that domain knowledge of financial institutions is important when you're trying to bring technology into it.
Yes, I think that's also one of the biggest changes that we've seen over the last 3 years certainly, but maybe even 5 years, is the greater number of talent that is in the digital asset space, which comes from traditional financial banking and markets, because it is a highly regulated space.
Yep.
It is a space where you always have to, as we discussed already, have safety and soundness at the forefront of thinking. We've gone through hundreds, maybe thousands of years of banking crises. We have all of our banking laws and regulations for good reason. And so that's why it's been such a huge benefit to have the talent from the different financial institutions, from trading firms, from hedge funds, from market makers, from exchanges enter the space, because you're seeing a maturation. That maturation is incredibly important for the digital asset space, because it also inspires legitimacy and credibility and safety.
And it's not just that the Layer 1 founders are putting on suits and ties for meetings
this is actually understanding what it means to be regulated.
Exactly, which they're doing, and coming to bank conferences and putting on these jackets, maybe not suits and ties.
I can't tell you the number of tech startups or VCs that I've spoken to over the years, including when I was at Citi speaking to clients or potential investments in portfolio companies, and trying to explain to them, well, you just can't do that. Well, why not? Because it's illegal. Well, why is it illegal? Because we have to protect people. And, you know, the technology world is very different. And so I think this sort of Cambrian explosion of new products, new services that are ready to go to market, that will get regulatory approval, is because you do have that talent going, again, who are used to being regulated in financial services, as opposed to a tech culture which is go fast and break things, which is the opposite of what you want in in the financial system.
You can't do that in finance, right? If you go fast and break things, you probably end up in
jail.
jail.
People lose their money. Well, people get hurt, right? And so
you need a little bit of that spirit of wanting to go fast and break things, without actually breaking the...
It's that partnership between innovation and safeguards.
Yeah. And it's definitely, I think the key message we want to leave our audience is that we've been talking about these themes for a long time, but those famous last words in finance, this time is different. But in the case of blockchain and digital assets in the institutional space, in the US, in Europe, it is different.
It is different because it's the regulatory clarity that's been holding it back. Look, I can't tell you the number of times, and my former Citi colleagues will agree, the number of times I said, no, can't invest in that. Why? Because we have a lack of regulatory clarity in the United States. If you are a regulated institution, you can't do things that may violate the regulations. And so I think you've got this convergence where people have been working on and building and testing the technology for almost 10 years now. So you feel confident that the technology works. You've done your pilots, you've done your minimum viable products, you've done pilots that are sponsored by regulatory authorities. So, of course, in Singapore, the MAS was very early, and Citi participated in some of these, very early to do pilots with in the institutional space to understand the benefits that blockchain technology could bring to financial market infrastructure. And now that's turned into, I think, over 100 different central banks around the world experimenting with CBDCs and understanding how they could modernize not just sort of their banking and payment rails in their countries, but also wholesale markets and the wholesale movement of money around the world. What a tremendous difference that is. So even in the United States, in the last several years, you had the New York Fed work together on a pilot called the Regulated Liability Network, which was an idea that came from Citi, actually, originally. I remember seeing the first paper about it. That was Tony McLaughlin, who's now one of those founders that you mentioned. And so, again, it's people who understand and know the system from the inside that are the ones that are the true revolutionaries. I think that's something that people don't realize. It's very exciting. So the technology is ready. People have tested it. It's ready to go. Now we finally have the regulations that are ready to go. And those things together, that's the catalyst.
Caroline, you've taken us on a magisterial journey through the world of digital assets on this podcast. So we're so grateful for you for sharing your time. Really appreciate that. And Ronit, as always, thank you. So thank you for this, and I look forward to continuing our conversation.
Thank you so much. It's a pleasure to be here.
Citigroup, Citi and Commodity Futures Trading Commission CFTC are not affiliated and are independent from each other. The speakers' views are their own and may not necessarily reflect the views of Citi or any of its affiliates. All opinions are subject to change without notice. Neither the information provided nor any opinion expressed constitutes a solicitation for the purchase or sale of any security. The expressions of opinion are not intended to be a forecast of future events or a guarantee of future results.